This is insanity. There's massive deliveries. Now, we're not running out of silver. People tell you we're out of silver. We're not yet, but we're being raided. The Comex is being raided. And you want to know how I know that the Comex is being raided? Well, it's because that they're taking the silver stocks. And I'm going to show you that. If I can get that come up, you guys are going to see that they're taking the silver stocks, and we're going to share that. Here we go real quick. Share silver stocks. Here we go. All right. So this is as of yesterday, which is the most recent available. Today's won't be available till tomorrow. Report date 1/21/26 of silver metal depository statistics. And I've highlighted the adjustments to inventory. There were 3 million ounces off of the Asahi depository that went from registered to eligible. That means it's not trading. It's not free float silver. Checking out the silver statistics, and I found some interesting data you guys are going to want to take a look at. I think silver's going on a massive run. And when I say massive, I mean massive. It's being run. We're seeing stocks come out. Well, I'm just going to show you the data. I think silver's running right now, and it may run to 150 like I predicted, and it may go to 150 faster than I thought. And it may be on the final leg of its run to unobtainium, and to where it's very hard to get. And I'm going to tell you what's happened literally overnight in terms of the supply chain in the U.S., in addition to giving you the data. Because as you guys know, I run a big gold and silver business in the U.S., and what my refiners and manufacturers are telling me is very, very interesting. So we're going to go to the data first, and then I'm going to give you the story about what's happening to physical 999 silver, and it's different than what was happening last week or just a few short days ago. This is big, 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 big news in silver. All right, here we go. So I'm just going to show you the price chart here on TradingView. I would show you the normal one that I normally give you on goldprice.org, but it's not showing up. I think so many people are hitting that site that the silver chart basically is not there. So this is, I'm sorry, Trading Economics. This is silver's price. This is just a daily chart, and you can see it's traded as low as 91. It's up to 96. So there's been a little bit of weakness in silver this week. It came down from about a high of about 93.5 last week to about, I want to say about 88, 89, and then it's popped back up. In fact, let's look at the 1 week chart. What did it get down to? It got down to below 88. It got down to 87 and about 21 cents. And then in just the last couple of days, it's popped back up to 96.41 as we're looking at it right now. This is astounding. That's a almost $8 increase in the span of about a day and a half, 2 days. It's running hard, and I'm going to show you why it's running hard. And I was going to show you the long-term silver chart. I mean, before we get into the data, look at this. This is stupid.
Unusually, silver futures are showing long positions across multiple months, not just the near-term contracts. Typically, traders concentrate short-term, but now we see bullish bets extending 6 to 9 months ahead. Open interest surged by over 4,000 contracts in a single day, defying historical norms. Such activity often indicates traders anticipate higher prices, not a decline. Even swap dealers and managed money, normally counterbalancing each other, are net short together, an extraordinarily rare alignment. Despite this, prices continue to climb. The futures market is now signaling a potential shortage or price squeeze, reflecting the tension between financial instruments and physical silver availability.
Okay, it was running $32 on March 25th, and it's a straight line up over the last several months with no major pullbacks. Now, that makes me nervous because from a technical perspective, you would expect there to be a pullback. Well, I don't, but there's not one, and up until this point, we had plenty of physical silver. I'll get to the physical silver in a moment. We may be starting to actually run out of freely available physical silver. And at first, it was just a refining problem. And I think there is silver still available. But I think worldwide, we're starting to run short on silver. All right, here's something that Craig at TF Metals posted on Twitter yesterday. And this was as of the 20th, earlier this week. That would have been Tuesday. He saw a net change right here on the right-hand side in the silver chart of an increase in open interest of 4,000 contracts. And if you pull this column down to here, 1,900 contracts were for March, which is the dominant month, because you can see 100,000 open interest. And then the next big month was May with 21,000 open interest. It added 851. And overall, across all of the coming months, because it's a futures market, so you're playing the futures price, an increase in 4,151 contracts. That typically means we're going to have a short increase in silver and a pull down in price. When you see that many contracts added in a day, it's usually short positioning, especially when you have a chart that looks like this. How many people are going to add 4,000 contracts on top of that? Because from a technical standpoint, you're cruising for a bruising, right? You're looking at it going, it's going to pull back at some point. We're going to lose our shirt. But it didn't. It increased 4,000 contracts, and that's not stopping the price. It's adding to the price. And this is a huge change from what we generally see in the silver market. Usually huge daily or weekly increases, in the open interest or short volume on silver, not long. And we also have a change of 1291 today. If you look at the right-hand chart, 982 contracts in May. And here's the thing. These aren't just going on the near-term dominant contract of March. These are coming down to May, to July, and to September. People are taking more bullish positions on silver, not just in the near-term trading month, futures month of March. They're taking them and extending them out 7 to 8 months of trading. People are going long silver, and they're going long silver on a longer timeline.
U.S. banks are shifting their positions, going net long on Comex silver, while foreign banks remain net short. This dynamic is critical. Foreign banks often short silver to acquire it at lower prices. The net positions highlight a subtle tug of war. U.S. institutions anticipating gains, foreign banks maneuvering for physical delivery. Swap dealers and bullion banks, typically balancing each other, are now aligned on the short side, yet prices are still rising. This rare configuration underscores how demand for physical silver is disrupting traditional market mechanics, creating an unusual scenario where financial and physical markets are increasingly interlinked.
So not only is the long interest increasing in silver, which is spiking that spot price, but people are making bets that 6 to 9 months from now, silver is going to be higher. This is huge. This is very rarely, if ever, done on the silver market. I've been covering this for 16 years. Very rarely, if ever, have I seen that in silver. And this is also very interesting. You guys have seen this chart a bunch of times. I'm only going to look at silver. And typically, I'll tell you that the bullion banks are net short 46.1%. So almost half of the short interest is the bullion banks. We know it's the swap dealers because you go over here and you look at the numbers. But here's what's really interesting. Look at the net changes. Look at this net change line. You look at the producer merchants right here, and you come down to net changes, and they've dropped an overall of 2,200 contracts long and 2,200 short. What is the net of that? It's about the same because they're dropping some longs and they're dropping some shorts. So the producer merchants aren't moving up their short position or their long position in any reasonable amount. So it's not the producers or the merchants or what we call the legitimate market hedges, people that actually deal in the physical to supply their business or to sell it to people who supply the business. They're staying out of the price changes. It's not the producers, the miners, or the merchants like the Samsungs and Apples. It ain't them. It's the swap dealers and managed money. Look at the swap dealers and managed money. The swap dealers dropped almost 6,000 longs. It means they've reduced their long position by 6,000 contracts, and they reduced the short by 2,300. But they've reduced about 3,600 more longs than short. It means they increased their overall short position as a percentage. They're going overall more short, the swap dealers are. And they're rotating out of contracts. They're dropping both long and shorts, but they're taking a higher net short position as a percentage. And that matters because it's the net short position or the net long position which determines prices. Because if you come in somebody comes in hot and issues a bunch of short contracts to get someone to take the other side, it's going to draw down prices. Well, not only are the swap dealers or bullion banks doing it, but the managed money's doing it. They dropped 4,178 longs and only 2,148 shorts.
January, a month normally quiet for deliveries, has seen astonishing silver offtake. Over 42 million ounces moved in what's traditionally a non-delivery month. This activity is largely driven by foreign entities seeking tangible silver, forcing contracts to be delivered early. Refiners report unprecedented strain, reflecting the physical market's tightening grip. While silver is not yet depleted, freely available inventory is diminishing. The interplay between futures contracts and real-world silver is intensifying. Investors should note, Rising prices paired with heavy delivery activity indicate a genuine supply squeeze, not just speculative trading. Physical silver is in high demand, and the market is feeling it.
For the first time in a long time, the managed money and the bullion banks are taking the same side of the trade, and they're going net short. And guess what that's not doing? It's not stopping the price. You have both the financial side and the bullion bank side, the market makers, and the financial side, which are the financial houses that hold these for their portfolios, for their clients, pension money, whatever kind of money. And they're both going more short, which is ultra rare. It's usually the financial houses and bullion banks on the other side of the same contract. No, they're both going net short, as I showed you on the commitment of traders chart. Look at this. Okay? And the price is still going up. That's astounding. The price is still going up. Well, let's look at American banks versus foreign banks. You guys know from a couple of weeks ago, I said in silver, this is a January bank participation report. I showed you December. And in December, for the first time in God knows how long, U.S. banks went net long on Comex and silver while the foreign banks were net short. Why would foreign banks want to be net short? Let me give you a clue. They want to be net short to bring the price down. Why? To get the silver. How do I know they're taking the silver? Well, wait until I show you registered stocks. That's really going to shock you. I think the foreign guys are in here shorting silver to get the physical out as cheaply as possible. I think that's what's happening. And I think they're pulling a lot of new demand through the supply chain to replenish silver stocks through the refiners. And that's why the refiners are so blocked up. They're max city. They are absolute max city. And I'll get to more on that in a moment. But here's the January bank participation report. We know in December, the U.S. banks went net long silver for the first time, and I don't even know how long. Did they do the same in January? Well, yes, they did. A little bit higher percentage. So we're going to take a look at silver. We're going to go down here to silver. Comex silver, these numbers, this is net long for U.S. banks, and this is net short. They're net long, 16,146 contracts, and net short, 15,099. That percentage of net long inched up a little for the U.S. banks. The non-U.S. banks went 50,766 contracts short and only 9,577 long. So of the banks, the net short is still 65,000 to 25,000. So these swap dealers, the banks collectively, are still net short silver, but the U.S. banks are more net long than they were last month by a sliver.
Registered silver, the portion available for delivery, is being converted to eligible status, reducing the free float supply. Recent reports show 3.7 million ounces moved off the trading-ready register. While total Comex inventory remains substantial, this shift signals a subtle hoarding of physical silver. Eligible silver is essentially locked away, inaccessible to the market. If this trend continues, shortages could accelerate. The physical supply chain is under strain, and foreign buyers appear to be the primary drivers. The classic tug between paper contracts and tangible metal is intensifying, hinting at a potential run on silver if supply continues to tighten and demand keeps climbing.
See, the U.S. banks are they're going long. They're saying, we see what silver's doing. We're going long. It's the foreign banks that are shorting. The foreign banks that are shorting. And then we have really high deliveries in January. January is not typically a big delivery month. How do I know that? Well, look at the amount of contracts in January. You only have 270 contracts left. The big trading month is in March. 100,000 contracts. Well, you have to have a bunch of contracts to get one of them delivered, right? If you only have 270 contracts left, and January is not typically a big delivery month for silver because you only get 6 big delivery months in silver a year. And it's March is the big one after December, not January. But despite that, they've managed to pull 8,561 contracts of 5,000 ounce silver off of the exchange in a typically a non-delivery month. And if you multiply 8,561 contracts, and each contract is 5,000 ounce silver, that's 42.8 million ounces of silver delivered in a typical non-delivery month. 42 million ounces of silver in a typical non-silver delivery month. And who's shorting silver? It's the foreign bank. The foreign banks want the silver. China, Russia, whoever, they're the ones that want the silver. They're shorting it to get it off on a non-delivery month, for crying out loud. And if you look at how that happened in silver, the first day they stood for 2,200, then 1168, then down here 1624 on the 7th, and it all adds up to a cumulative total so far of 8561. And we got a couple of delivery days left, not many, okay? But we got a few left. We might get to 9,000 contract. We may get to 43, 44 million ounces. And what is considered a non-delivery month, because there's not any open interest left. March is the big trading month. And what we saw was people bringing contracts forward into January. I've never in 16 years seen that at the level it was. Usually you push your contracts out, because if you want a position and as the end of the month comes, you got to rotate out of your current month into the next month. It's a futures market. You're not looking back on price. You don't bring a futures contract back to you from March to January, but that's exactly what was happening. Why? To get the deliveries. And who's getting the deliveries? The foreign banks, who are keeping the price down so they can get it cheaper. And despite them doing that, the price has gone straight up since freaking March.
Silver's rally is fueled by both speculation and real-world scarcity. Unprecedented demand, delivery pressure, and strategic moves by global banks are reshaping the market. Prices are climbing despite increasing net short positions from major institutions, a scenario rarely seen. Refiners are overwhelmed and Comex inventories are tightening, signaling that silver is moving into hands willing to hold it. For investors, this is a pivotal moment. The market is hinting at a historic run, possibly pushing silver to levels long considered extreme. Understanding these forces now is essential for anyone watching the future of precious metals.
This is insanity. There's massive deliveries. Now, we're not running out of silver. People tell you we're out of silver. We're not yet, but we're being raided. The Comex is being raided. And you want to know how I know that the Comex is being raided? Well, it's because that they're taking the silver stocks. And I'm going to show you that. If I can get that come up, you guys are going to see that they're taking the silver stocks, and we're going to share that. Here we go real quick. Share silver stocks. Here we go. All right. So this is as of yesterday, which is the most recent available. Today's won't be available till tomorrow. Report date 1/21/26 of silver metal depository statistics. And I've highlighted the adjustments to inventory. There were 3 million ounces off of the Asahi depository that went from registered to eligible. That means it's not trading. It's not free float silver. Free float silver is what you can deliver on a contract. This eligible category here is not deliverable. The registered is, okay? So it's being moved to registered because somebody wanted it, claimed it, and they put it in eligible. Eligible means it's owned by somebody, and they're not allowing it to trade, okay? And a couple other depositories. We go down here, yet a net move of 3.7 million ounces of silver that's no longer liquid. We had over 119 million. Let me highlight this in red for you. We had over 119, well, maybe orange. We had over 119 million as of last week. Last week, 119 million ounces were in register that could be delivered. 3.7 million ounces came off. Why did 3.7 million ounces come off? Because people are in there taking the silver. Okay, do you get what's going on? Who's shorting the silver? It's not U.S. banks. The biggest shorters are the bullion banks. I showed you on the COT report. And the biggest shorters out of those banks are who? Foreign banks. Foreign banks are shorting silver to keep the price down. And somebody's taking delivery. I'm guessing it's the foreign banks who want it. For what? They're foreign customers. The U.S. Comex is being rated for physical. Now, there's still 116 million ounces in registered. And as long as that number is legitimate, not a complete fabrication and a lie, which we don't know. People are going to say it on social media. They're going to say it's a lie, it's a lie. And they could be true. We just don't know. We don't have that data to look at. I'm an auditor.